Hi there, this is Christian Dye from Latitude West Financial, and it is April 5th, 2025, a couple of days after the tariff announcement. I'm glad that I have Ryan Runte and Tariff joining us. And what I want to do is give an update from our perspective as to what's going on in both the real estate and the stock market. Questions we'll take at the end. Just put them in the chat. And for those of you who are watching this as a recording, then by all means feel free to reach out to us at the end and ask us your questions. So I'm gonna dive right in here because I know we have a lot of different things that we want to go over. If everybody could just put their microphones on mute and their videos off, that would be great. So, a quick little disclaimer here that the information today is not to promote the buying or not buying of any real estate or stocks. What we're doing is we're just giving you education as to the research that we're seeing, as well as the environment that we're experiencing. But we say that use your team, use your own professional team to figure out what your next move is going to be. So let's dive right in here. What is the real estate market outlook for 2025? So with the tariffs, of course, there's been a 10% overall tariff on all foreign imported goods into the US and a 25% on Canadian imported autos and other autos. We seem to have dodged a little bit of a bullet on a lot of our other consumer goods, but many countries did not. All of this is going to change, of course. That's the big message over here, that we don't really know the full ripple effect because we're at the very beginning. But so far, what has the result been? You know, for sure, there has been, without a doubt, low consumer confidence. What happens with low consumer confidence is a lack of spending. Everyone agrees that this is going to affect each country inward, as in things are just going to be more expensive, especially for the Americans. But Canada is definitely going to feel this as well. We're already feeling, very high inflation. So everyone is saying the same thing. Inflation is absolutely guaranteed. And when when we experience inflation, we often tend to spend a little bit less, which means our GDP goes down. We're starting to see, and from what I'm hearing, and then Ryan and Daryl will probably chime in on this, but I sort of feel that there's a lot of housing purchasing delay going on in the market, and that's typically what happens when consumer confidence is low. But when it's delayed, usually what you end up getting, and we saw this in COVID, is pent up demand because people got to buy. In And then when it's unleashed and when all of a sudden there is great consumer confidence, or there's a trigger point like low interest rates, like historically low interest rates in the last, 10 years or something like that, all of a sudden there's the crazy starts all over again. In Vancouver, we've seen that several times. So those are some of the things that can happen with this tariff effect coming in 2025. So I want to look at Vancouver housing prices just from an analytical perspective. So just to highlight a few things over here, our most recent data was the data from February 2025. March isn't quite out yet. It should be out pretty quickly. But essentially, the amount of listings was down 28.9%, below the 10-year seasonal average. But it had an 11.7% decrease from this time last year. Now, housing prices have pretty much been the same over the last year. So February 2024 to February 2025, there's been a 0.3% increase, which is pretty much nominal. Essentially, it's been quite flat. But just to remind you, that's still really high. Like the average detached house in the Lower Mainland is still $2 million. The average attachment 1.1, and then the average condo is about 760,000. So a quick little view as to where we are in the market. Market update stats show sales to active listings for February 2025 as a total of about 14.8%. Now, detached, attached, and condos are all a little bit different. But to remind you what this kind of means is that if sales to active listings is below 12%, that's typically a buyer's market. If sales to active listings is above 20%, that's typically a seller's market. In other words, that usually when it's above 20%, that's where we get these really, really, really hot markets where things are going crazy, over asking, all of that other stuff. But when we're kind of inside that between 12 and 20, it's a little bit more of a balance. But that's just on paper. That doesn't mean that that's actually what's going on over here. So to give you a little bit of a trend line over here, this time last year, we were much higher, like in the 20s, and for detached homes around 16. And then in August of 2024, we slowly started to trickle down. And in December 2024, which was a very, very slow time, again, we started to trickle down. So if you were to think of it as a trend line, we seem to be trending downwards with the tariffs and the consumer and confidence. That kind of tells me that we might be headed for a slowdown. And the reason why I say might is because there's two things that I've realized that are very, very unpredictable. One is a Vancouver real estate market, and number two is a Trump government. Add those two things together, almost anything might happen. So what I want to do is I want to shift gears to Ryan to get his opinion. And the reason is Ryan essentially has got a real estate team, but they're on the front line. So I have data from February of 2025, and it sort of says we're kind of balanced. But Ryan's going to kind of tell us what he's seeing, which is literally, April, first week of April, last week of March, what's going on. So Ryan, my usual questions, what is going on out there?
Sure. Yeah. Good morning. Yeah, so it's kind of hit or miss. There's quite a bit of inventory. I'm going to say it's actually a buyer's market for the most part, especially for condos and especially for the newer condos, like ones within the last 1 to 5 years. Like Burnaby, I just looked at the stats today. So Burnaby and Coquitlam, for example, for new one bedroom, so condos within the last 5 years, is over 800 listings. So it's pretty crazy. And we have buyers looking right now for that, and it's pretty aggressive. There's been a lot of price drops in that market. Otherwise, it's sort of hit or miss. Like we've had some house listings in March that we sold under 2 million, just kind of more the entry level point, and they sold relatively quickly. But I would say like condos, especially one bedrooms, it's definitely a buyer's market. There's a lot of inventory. And some of these people that bought in the last couple of years from a pre-sale perspective, a lot of them at a loss or maybe best case break even because there's just so much competition.
Yeah, Ryan, from a pricing perspective over there, um, like these one bed condos, that like Toronto, I know is having like a huge problem as well, just too much supply.
Yeah.
Not enough to absorb it. Them limiting the amount of international
Yeah, foreigners.
temporary residents coming in does not help the situation at all. And of course, who could have saw that 3 years ago? But what do you find that yeah, there it's a buyer's market, but do you actually think any of it's a deal, like as an investor, or it's not going to cash flow, or
Right.
this is good for somebody who's wants to come in and rent it out as an investment, or this is good for somebody who was going to buy this type of product anyway, and now's a good time to get in? What's your opinion?
I think it's a good time to get in for long term. It's difficult on the rental side because the rents have actually gone down. Similar kind of reason. There's just so much inventory. So our rents have actually gone down as well, like a few $100s, for example, on the one bedrooms. But I think it's a good time because, like, for example, I had a one bedroom in the city of Lougheed, brand new 2023. I sold for 660. Those same units are now going under 600,000. So it'll come back. We've seen these same cycles before, like the beginning of COVID. So if the rates drop more aggressively, this inventory will get eaten up and the prices will start to go up. So we're kind of in the, I think, in the same cycle that if you buy something now, when this inventory gets eaten up, the prices will start to go back up and the rental market will get busier again as more people come. So I think it's a good time right now because you can negotiate. You're not dealing with the multiple offers on these products. There's a lot of motivated sellers. So I think if you're looking at long term right now, like we always sort of say 3 to 5 years. It's a good time, especially for the newer one bedrooms.
Yeah, yeah. Like and we have seen that. We've been working with each other for a very, very long time. We have
Yeah,
seen that where the example that you gave right there, you had a place for you sold for 660. Let's
yeah,
say someone picks that up for, 580, for
yeah.
example. And then in 4 or 5 years, when this market starts to pick back up and it's back up to a 660 or higher, and then all of a sudden you're like, yes, I had to put a pretty good chunk of a down payment in order
Mhm.
to get this thing to break even or to minimize the negative cash flow. But then it ended up being like a really, really good return. I guess it's how much confidence do you have that this is going to rebound from a Vancouver market perspective? And just historically, it always has.
Yeah, I think and I always say the 5 years, and that's usually proven to be correct. So I think if you're looking, 3 to 5 years, we say, but I think 5 years for sure, it's going to bounce back because, I mean, at the end of the day, we still don't have enough supply. It's just we're kind of an oversupply right now, but that's once that gets eaten up, we're at the same cycle. So yeah, l long term, 5 years, I think you'll be in good shape. And there's definitely deals out there. It's just unfortunate timing wise. Some of these people that bought pre-sale the last couple of years are the ones that are really feeling the pinch right now. But yeah, definite opportunities, I think, for buyers.
If I want to shift gears to single like to detached homes
Yeah,
for
yeah,
yeah, like, do you feel, because usually when we see the trend line going down, you
yeah.
actually think it's a good time to move and maybe upscale, because usually that there's that rule that you want to if you know you're going to upgrade your house, if you have like a 3 bedroom townhouse like I had at one point, and
Mm,
then I started popping out the kids, and then all of a sudden it's like this is not going to work for our 5 year plan. And then I actually waited till the market was going down, and this was in 2008 financial collapse, and I thought this is the perfect time for me to sell. I'll take a hit, but the next guy will take an even bigger hit. What are your thoughts
yeah.
about movement in terms of, hey, should I
Yeah.
be
So
moving?
yeah, for sure. So there, I just have an example actually from March was relatively busy for us. So we had one house listed in Ladner for 1450. We sold it for 1445, but this is sort of the entry level point. So houses that are under 2 million are still getting some traction. Once you're over 2 million, it's tough, especially now with the tariffs and stuff, people are concerned. But there's some opportunities like the one that we just had because it sold for 1445. They bought a house in Poco under 1.9. So, and the house they bought in Poco, they got, I think, about 50 or 60 grand off. So there's opportunities, but the problem is with the detached houses, it's the affordability factor. So even though the rates are coming down, people are concerned and still not as many people can afford the houses over 2 million. You need to have the suite and the mortgage helper. But the ones under 2 million, I think there's some decent traction right now. And especially this time of year, people are wanting to sell and get into a new property like over the summertime. So they're ready to go for the school year if they have kids and stuff, which was kind of our example. So there's decent traction, I would say under 2 million for detached houses, but over that, it's slow from what we're seeing.
So if you were over 2 million and you were thinking of bumping that up to maybe 3 million, would you say that it's going to be a hard go because it'll be hard to get rid of yours? Or are you going to get a smoking good deal on that 3 million because that's an even worse price bracket?
Yeah, like it's going to be somewhat relative. I think that over 2 million, it's going to be slower to sell, and you're probably negotiating a little bit. But also, yeah, on the 3 million plus, they should be more aggressive. So, it's if you're making a move up and you have a lot of equity in your home when you have a house over 2 million, it's probably a good time because you can negotiate more on the other side. It's just the place that you have to sell is probably not going to fly off the shelf. It's probably going to take a few months at least.
Got it. Got it. And then Ryan, like I said, some predictions, future outlook. When do you think,
Hmm.
like when do you like Vancouver is typically, I'm just going to throw it out there, 80% of the time it's like a seller's market. Like it's always that
Yeah.
crazy. When do you think we're going to kind of get back to there where people are, buying, and the Kraken has been unleashed, and all of a
Yeah.
sudden we're in this crazy market and everyone's scratching themselves and scratching their heads and say, why the hell didn't I buy X amount of
Yeah.
months ago. It's same product, same thing, same environment, almost the same interest rates. What the hell was I thinking? Like, when do you think that the cloud is going to lift?
You know what? I think it's very similar to the last cycle, like the 2020 with COVID. It seems like the same feeling. A lot of people are nervous because their portfolios are down, the rates are still high-ish. I think when the rates start dropping more aggressively, like I think Daryl will touch on that, we have another rate decrease this month. That seems to be how the Vancouver people follow the market is they're really heavily weigh it on rate, which is not necessarily the way that you should do it. Because when the rates drop aggressively, people jump back in, then you're dealing with multiple offers and probably paying more. But that's what I think the market will pick back up. So I would say probably later this year into next, if these rates get more aggressive drops, you're going to see people coming off the sidelines that are going to start jumping in to buy. And I know that as a fact because we have clients, it's the same thing. They're saying, oh, we're waiting for, 0.75, or we're waiting for another, 1% drop. And we're saying, well, why are you waiting for that when you can get a deal now? It's all relative. And in fact, you might get a better deal now because you're able to negotiate more. But that's just sort of the mentality of people, and that's been the way for some time.
So here's an interesting one. What if someone was sitting on cash? Either they were a first-time home buyer and they had their down payment, or they were lucky enough to kind of have sold in the last 3 months and they're literally just sitting on cash. Do you think now is the right time that they should be making an offer because it's more of a buyer's? And I'm probably talking, not entry level things, maybe a townhouse or a better condo or a house. Or do
Yeah.
you think it's hold and wait, hold and wait, hold and wait? Ryan, what is your opinion?
I would say if you have the cash now, especially the down payment, I would say look now because you have a lot of inventory. There's a lot of stuff out there, and you're able to negotiate more. So, and we've seen it in the past how quickly that can change, especially, COVID, it
Yeah,
was pretty much completely dead at the beginning of COVID. Nobody knew what was going to happen. And it kind of feels like that now, especially with the market drop the last couple of days, but it changes very quickly. So I would say if you have cash sitting now and you plan to buy, you're planning to buy anyways, now is the time that you can negotiate more.
perfect, perfect. Okay. What I want to do is I do want to transition. Thank you, Ryan. And we are going to
Well,
have questions at the end. So if
sure,
somebody
yeah.
has a question for Ryan, he's not going anywhere. Okay. I kind of want to switch gears to Dara with CY Mortgages, and he's always been kind of our frontline information as to what he's seeing for clients. How many people are qualifying, how many people are actually buying. Um, so right now, the Bank of Canada, of course, the prime rate is down. It peaked at 7.2 and now it's down all the way to 4.95. In April, we potentially might have another rate drop. Dara, right now, tell us a little bit about what you're seeing with rates and what you're seeing with clients.
Yeah, no problem. Good morning. I would say we're seeing a lot of uncertainty. It's been nice for the past 8 to 10 months to see rates coming back down. I think that was a pretty tough period for the last couple of years, and so it's nice to get some relief from that. We've had a fairly busy start to the year, and I think that's a direct result of rates coming down, as Ryan touched on. That's it's a direct relation to a relationship with affordability at the end of the day. So, with the rates trending down, we have seen quite a bit more activity, but definitely get the sense that there is a lot of people on the sidelines with the uncertainty of what's going on with the trade wars and that for sure.
Got it. Got it. And then, so right now, I guess to give us a little bit of perspective, if you would have bought a place 6 months ago, like right now, you're saying that the fixed rate, a lot of people going fixed, it's ranging between low fours all the way up to fives. Can you tighten that number up just a little bit for us? What do you think? Like, what's kind of a decent rate that you've seen on the 5 year or the 3 year recently?
Yeah, for sure I can, and it's tough because I like to give a range because there's a lot of moving parts. To give you an example, someone like a first-time buyer who's buying a home with less than 20% down, their mortgage is required to be insured by CMHC. What that means is that there's no risk for the bank or less risk for the bank, so they're going to get a better rate than say someone coming in and buying for 2 million with 50% down. So to give you an example of the range, a typical, what I would call a conventional mortgage, meaning not CMHC insured, you're around 4.19 on a 3-year fixed right now. You're probably somewhere between 4.19 and 4.39 for a 5-year fixed. Someone that's putting less than 20 down, the silver lining, they have to obtain this insurance and pay for it. But silver lining for them is the rates were even lower. We're seeing rates for them in the threes. So
Wow.
like 3.89 to 3.99 kind of range.
Let me just make sure that I got this right. So someone who's getting a CMHC loan on their mortgage because they're coming up with less than 20% down, which is 1.5 million or lower, which would
Correct.
qualify them because they bumped it.
Correct.
They're getting lower rates.
They are getting lower rates, yeah. Because what happens there is the Bank Act requires that mortgage when with less than 20 down to be insured by CMHC. That policy provided by CMHC is not for the borrower. It doesn't benefit the borrower, it benefits the bank. It basically gives the bank coverage that if that person ever defaults or doesn't pay, the banks aren't paying any losses. So
Yeah.
uh, the borrower paying for it. There's no benefit to the borrower, but because the risk is taken out of it for the bank, they are able to offer a lower rate. So as I mentioned, that's kind of the silver lining of that situation.
So with that, it actually makes the house more affordable then because the
Yeah,
rates come down.
well, it's arguable. I mean, the CMHC premium they have to pay really offsets a lot of that difference in the rate. So I wouldn't
Yeah.
look at it as they're saving a lot of money. It's more like they're offsetting that additional cost they have to now absorb because they don't have that 20% down.
But on paper, aren't they just but they are able to qualify for more though, aren't they?
They are, absolutely.
Perfect.
Yes.
Okay.
Yes.
Yeah.
And
Yeah.
for one more note on that, as you mentioned, CMHC increased their coverage up to 1.5 million. They've also bumped their maximum amortization from 25 to 30 years. So these people who want to get in the market for the first time can now go up to 1.5. They can stretch their mortgage over a longer period and have a lower payment. That's really addressed some affordability for a lot of people, actually.
Got it. Got it. Wonderful. Okay. The $1 million question, Dara, future outlook, where do you think the rates will land? And I know you're not saying this is going to happen. This is just kind of speculation. But what are you hearing in the chatter? And, when you go to your meetings, where do you think the rates are going to land?
Yeah, very difficult to predict for sure. I've been in this business over 20 years now, and we've always kind of been able to formulate a thesis to guide us. We could never predict, and some wild things have happened. We know that, but we've always been able to sort of formulate a thesis based on following economists and what's going to happen. Right now, it's pretty tough to come up with a reliable thesis with all this uncertainty in this tariff business, and it changes every day. I would say the consensus amongst most economists is that we continue to go down on rates. We were heading that direction anyways because of inflation easing, but I think we are also going to see the tariffs impact that. So some predictions, popular, common, were 1% further for the rest of the year, and that was prior to the most recent cut we got in March. So to summarize, I would say the consensus is we get about a 0.75 decrease to the bank prime over the remaining calendar year.
That's right.
There is some in the camp that say that could go the other way. Tariffs could cause inflation. So, it's tricky. I would definitely say the consensus is down though. And I think more than ever, people need to not try to worry about predicting so much what's going to happen and do what's best for their situation and their risk tolerance.
Yeah, absolutely. I guess for me, I've always said if you're in like this window of buying, you get that 120 days of pre-qualification. And if somebody says, "Hey, I'm thinking of buying, and but I'm hearing that rates are going to continue to go down, so why don't I just keep waiting?" Then I would still say get pre-qualified because the problem is, what if they go the other direction? If you lock into that low rate, you get pre-qualified and the rates go up, you get the lower rate. If you get pre-qualified and the rates go lower, you get the lower rate. There's absolutely, and that's, I think, me saying, you're going to buy between 3 and 6 months. If you're not buying for another 2 years, then don't. But if you're really, really interested and you're inside that window, or you're holding cash and you're thinking of jumping in, going through the process, you have to go through it anyway. Of getting pre-qualified is always what my recommendation is. Um, yeah. So what I want to do is I want to shift gears to make sure that we have enough time to answer questions, and I kind of want to go through my stock market outlook report. Um, so what has happened as of April 2nd, 2025, with the tariff announcement? Essentially, the result has been, if you've been listening to news, all the global markets have actually gone down. Pretty much every single index has gone down as well. It's just a matter of how many. It's the worst two straight trading days. The announcement was on Wednesday. Thursday and Friday had two terrible trading days. And it was the worst since they've seen from COVID. What a lot of investment managers, what a lot of large portfolio managers are doing is they're essentially they can't go into cash. They have to keep money moving. So they're getting away from riskier assets that are unpredictable, that are tied to these tariffs, such as tech. Like tech has taken a huge hit, and they're just doing more predictable things like consumer staples and healthcare. But one thing everyone is agreeing on is that there's more uncertainty to come, because we really don't know. We haven't felt the full effect, because we haven't felt the full effect of the retaliation tariffs. Still, there's more tariff news to come out. And then at the end of the day, there's also the unpredictability of Donald Trump. So, recession, global markets, and Trump as a wild card. So, just to show you how much of a wild card he was, a lot of people actually said, you know what, even though I don't like the guy, I do like my stock portfolio. He's better for the economy. Last time he was better for the economy, there was a huge surge in the first year of his presidency with the stock market. I'm gonna, vote Trump. Automatically, he was predicted stock market to go up, and his first term, and it's gone in the complete opposite direction. So the reality is now the S&P is down 14% year to date. A lot of people are saying that the 12-month window has eliminated all of the gains that were created, depending on what you were invested in. So that much of a wild card is not a good thing in terms of the stock outlook, because really it isn't, Christian, is it going to go up or is it going to go down? I think just for certain, it's just uncertainty. That's what it is. It's just uncertainty. So a lot of people like to pay attention to the big guys, the FANG stocks, is like they like to call it. This is Facebook, Apple, Amazon, Netflix, and Google. Let's just take a look over here. Every single one of them is down. So Facebook, which is called Meta, is the one who's down the most, and that's at negative 32%. So this is all down from their peak. So most of their peaks were in February. Some of their peaks were in 2024. So this is down from their peak. But of course, there's probably two other kind of popular big names a lot of people kind of follow, and that is Tesla and Nvidia. Now, Tesla is in a completely different category of its own. It's not only down, but there are people vandalizing Tesla dealerships. There's people very, very anti-Tesla, and I think that's because of the correlation, of course, with Elon Musk and Donald Trump. So Tesla is even be more of a wild card, because even though it's a good company and they produce a good product, the negative effect just might be the politics itself. So me and my team, we started to do some research. Now, does this mean get out of these stocks if you're in them? Absolutely not. But we did an interesting analysis. We basically looked at it from the strength of the company and tried to narrow down which of these they're down. Does that mean there's a buying opportunity? Probably yes. But which are the two that are most probable to recover back to its peak within 2 years? That was the analysis that we did. And we've discovered Apple and Meta, which is Facebook, excuse me, were the two that were most likely, just by the strength of the company, cash on reserve. And then they actually do have several things non-correlated to what might happen with the tariffs. But again, I have to say it again, I'm not giving direct stock advice. I'm just giving you some education. You should be doing all of your own information. But I think it's good to start to think of this way. Is there a sale? And is there something I might want to get involved with? Okay. So There's a guy I follow a lot. His name is Tom Lee. He's a fund strat financial analyst. Essentially, he's more right than he is wrong. And I really, really got to follow him a lot, especially during COVID, because we were navigating what we were doing with clients. So what does Tom Lee say? He says, without a doubt, it's going to be volatile for all global markets. And his recommendation for 2025 is number one, don't panic sell. So a lot of people said, well, if we're declining down, shouldn't I be selling? Remember, it's very, very unpredictable. Maybe we're at the bottom right now. Maybe we get the bounce next week. We don't know. So one thing he's saying is don't panic sell. But the big thing he is saying is preservation of capital should be your number one goal. If you've got, an 80% stock portfolio as all of your assets and RSPs and TFSAs and things of that sort, then really what you should be doing for 2025 is preserving capital, trying to preserve this so that you don't take such a great impact. Now, everyone has always heard, have a diversified portfolio. He's now saying, have a more diversified portfolio. Why? Because of the uncertainty that's coming along, So that's what Tom Lee from Fundstrat is saying. So right now, recession is on everybody's mind. So there's an actual recession probability graph. And in January, it was at 23%. That means that they said there's a 23% chance of there being a recession. JP Morgan, as of yesterday, has now bumped that to 60%, over double. So now they're saying there's over a 60% chance of there being a recession. Keep an eye on this. I guarantee next week this number will change. It won't be 60%. At the end of next week, it might be 50, it might be 80. Right now, just to remind you what happens with a recession, that's 2 consecutive quarters of negative GDP. Okay, is Canada in a recession? Is the US in a recession? But here's the thing, it typically takes 7 months for them to announce that there was a recession. They don't announce that we're in a recession because they need 2 consecutive quarters. So we actually have to have 2 quarters go by, which is, typically 3 months and 3 months. And then in that 6 months, in that 7th month, that's where they announce, hey, guess what? We're having a recession. And it says, oh man, we're having a recession. Actually, we've been having a recession for the last 6 months. So what's going to happen in a recession is this. For sure, you're going to get volatility in the stock market. With recession, when people prepare for recession, they don't want to go under. So what does that mean? Imagine you're a company and you're preparing for less sales. You're preparing for less buyers. You're preparing for an uncertain economy. Unfortunately, they start cutting jobs. Why do they start cutting jobs? Is because they got to pay these people. And if there's not enough money coming in, they could end up folding or going bankrupt themselves. So then you start to get the layoffs. And right now, the announcements in the US and in the auto industry, as well as like in Canada, in the auto industry, in the steel industry, we're already hearing it. In Canada, we're already hearing it. Just turn on the news and listen to job reports and listen to the layoffs and listen to companies laying people off over here. And that's just the people that have been laid off. Now, what about the people that are uncertain about their job? They're like, hey, wait a minute, I'm working a related industry over here. Is my job at risk over here? Possibly. So if your job is at risk, are you going to be traveling to Europe this year? Are you going to be buying a new car? Are you going to be buying a new house? And if the answer is no, I'm going to play it safe and I got some cash stored on the side. Am I going to, go on that next vacation, or am I going to, I'm going to probably cut back on my restaurants. Anything I don't have to buy, I probably won't buy. That's a recession. That's people having lower GDP over here. So now, again, what might stimulate us to get out of a recession, of course, is lower interest rates. So that's another reason why we might, because the government often will say, God, we got to get out of this recession. Let's lower the interest rates. And oftentimes they lower the interest rates to stimulate housing, to stimulate, buyers, to stimulate companies wanting to borrow more money in order to reinvest in their company or reinvest in infrastructure. But remember, November of this year is when you're going to hear the announcement. Yeah, we're in recession, but just listen to the news on a daily basis. And if you hear the words, people are spending less, people are going out less, consumer confidence is low, then we're in a recession, and just look at your own spending as well. Okay, so there's another thing called the uncertainty index. So So first of all, the stock market does not like uncertainty. Absolutely not. So right now, the uncertainty index has not been this high since COVID. So what do you get as when you get uncertainty? When you get uncertainty, you get a very, very nervous stock market. And then this is what starts to push all of those other factors. Now, when I talk about Trump, the one thing that I think we could all agree on, whether you agree with his politics or not, you got to agree that he's creating enemies, without a doubt. No matter whether you're pro or con Trump, you got to agree that there's a lot of people rallying it. And I'm not talking individuals, I'm talking countries. I'm talking countries that are now rallying against him. So what happens if I had one, I saw it on CTV News. I had one, I can't remember who it was. One person said that countries should be looking at Trump like Bruce Lee. How would you take on Bruce Lee? And the answer is you would align against him together and then go after him. And that just over there kind of tells me that there might be a very, very, very anti-US sentiment out there. Like we're talking people no longer visiting the US. People like I've already seen on the news that there's certain grocery stores that are labeling with a dot or something like that US products, just so that when you're going down the aisle, you can clearly see, hey, that's a US product and that's a non-US product, and it might change your buying decision over here. So what might we see? US boycotts. Like, and I mean, I'm not traveling to US anymore, or I'm not buying US goods anymore, or I'm not investing in US companies anymore. And this is where people are starting to say the S&P 500, I'm now questioning whether I should be investing in the S&P 500. And they start to say there are other alternatives out there where I could be investing my money. So do I really, really, really want to put my money into the top 500 US companies? And that's, I think, some of the sentiment that we might end up getting if this starts to get a lot worse. So downward pressure on US stocks. Now, there was another report about the effect of all of the tariffs that are going to come through, which is who's going to be impacted the most. And it's interesting because these were U.S. analysts saying this on CNBC, and they were actually saying Trump may have inadvertently might inadvertently make the EU great again, because they seem to be the ones statistically that might have not only the least impact, but actually the greatest positive effect of this, which is crazy. So what might end up happening is you get all of these other trading partners now trading amongst themselves, almost doing a boycott on the US. And they said statistically, unfortunately, Canada wasn't the ones where they said Canada will become great again, but because it's our closest trading partner. But the EU might end up being someone who actually, I'm not going to say benefits from that, but is impacted the least and ends up, getting a little bit of a positive effect. So, shifting to Canadian patriotic investing. A lot of people, I've had clients kind of saying, what are my alternatives for, keeping my money in Canada? Like if I'm not going to go visit the US, does it make sense for me to continue to invest in the S&P 500 and support, Amazon and support Tesla and all of these other big names, right? If I'm kind of a little upset with the US and what they're doing and upset with that government, well, to me, it seems to make sense. If you're buying less US products, and if you actually have chosen to not go your next vacation into the US, but still you're investing heavily into US products, I'm not sure if that's a bit of a paradox. So support Canadian products and invest in Canadian companies. So what are we recommending for clients as well? If you are invested in the US, don't panic sell, don't sell all of your stuff. But if you are, looking for, is there going to be a correction or something of that sort? Remember what we did back in COVID for those of you who are clients. We like when it breaches 20%. 20% from peak, we're already at 14%, but at 20% per peak, we're talking with clients like right away, and we're saying, I think we're on a really, really good sale. Are you still comfortable with investing in a down market, especially if it's an American market? And if the answer is yes, then we build a strategy. We build a strategy around it. It could be dollar cost. It could be a hedging strategy of more money coming in. It could be a leverage strategy. But I think keep that in mind. 20%, you're in a fantastic correction. 30%, you're in a crash, which is even better. Okay, so keep those numbers in mind. Canadian private equities, I'm going to sound like a little bit of a broken record over here, but we've always been saying Canadian private equities, they've got amazing returns, absolutely fantastic returns, really, really solid 18 to 13% without the volatility, right? So stock market usually has, 16 to 18, US stock market usually has 16 to 18% standard deviation. Ours usually has less than 4%. Canadian private equity. And then, of course, Canadian state bonds. And that's because, of course, again, low volatility. And if you're incorporated, these are incredibly, incredibly tax efficient. So a quick slide on the estate bonds over here. They've had a historic, this is slightly outdated slide, but the numbers are about the same. So almost about a 6% dividend yields, and then with only a less than a 2% standard deviation, whereas the stock market, S&P TSX index has been about 9, but we had that huge standard deviation. Now, bonds, a lot of people who go into bonds, but the yields, really, really safe bonds, are quite low. But one thing I want to notice, these government bonds might have a very attractive low standard deviation, 2%, but their yield is quite low. So estate bonds actually have a lower standard deviation with a higher return. So Canadian state bonds is something, especially if you're incorporated, we recommend clients to start a conversation with us. And then, of course, our private equity funds. I cannot release the names because I don't have permission. But if anyone wanted to connect about our private equity funds, then they're absolutely able to. So one thing I want you to notice about our private equity fund number 1, Canadian Private Equity Fund, we've had this fantastic, low double-digit return over the past, looks like 14 years, but no negative years. So we're not victim to standard deviation. So last year they returned a 9, nothing wrong with that, but we've had these wonderful double-digit years. So we're saying, not saying don't invest in the stock market, but for our clients, we're encouraging that they do Canadian private equity because it keeps the money in Canada. Most of these are all real estate based, and of course, real estate in Canada is for the long term continue to do well because we do not have enough supply, but we have more than enough demand. Private equity fund number 2, again, a real estate based one. Year to date, we're already up 2.15%. Now, if you take a look at the last 4 years, they were all low, nice, stable, double-digit returns. And if you remember what happened in 2021, the S&P 500 took a huge double-digit negative hit. So why don't we get those same wonderful returns without the volatility is my question. If we follow this trend line over here, the last few years that they started off this strong, they ended up in the low double-digit territory, which we expect as well to go again. Our last one over here, same thing. We're already up 1.62%. Stock market is down 14%. So we're saying, why don't you invest in Canada? Why don't you do something that's more stable? And why don't you think of private equity? And the reason we say private equity is because our TSX is 100% going to be affected with the US S&P 500. Studies show the Cambridge Associates showed that private equity over the past 25 years has on average returned 13%, even though the Russell 3000 has only returned 8%. So a lot of people are putting money in the stock market. We highly think that they should be diversifying into more private equity. Tony Robbins wrote his book, The Holy Grail of Investing. He did a 40-year study. Comparison was similar. 9.2% over 40 years in the S&P 500. Private equity at 14.3%. So if anyone would like to talk a little bit more about that, it is a longer conversation because there is a huge basket of things to put in, a huge basket of options. And remember, private equity is exactly that, which means it's not public, which means it's hard for the individual investor to find these completely on their own. Typically, you need to go through a licensed MD advisor, and you also sometimes need to be accredited investor. So it's not as easy as, hey, I want to put $100 into that. Sometimes the minimum are starting at 25K. But if it is something that you wanted to chat about, feel free to connect with us. Our formula at Latitude West is it tries to mimic the Tiger 21. Tiger 21 are the wealthiest investors on the planet, and that is we do not believe that we should have all of our money in the stock market. We believe some in the stock market, some in the private equity market, some in real estate, and of course, some in some form of fixed income, such as estate bonds. This is kind of a breakdown of the types of returns that we're looking for. For private equity, we're looking for, somewhere between 8 and 14%. Public equity, just somewhere between 6 to 10. For real estate, we want things this is direct ownership real estate, not private equity. We want things that are cap rates of over 4% with money going in 20% or lower as our down payment. That's our loan to value. For the fixed income, we of course want to build up our CDA credits for incorporated, and we're looking for fixed income somewhere between 4 and 5%. So how I kind of want to just shift and end off with some real estate over here. What is going on with our clients, and most of you know, we help clients to invest in real estate, but it might not just be in Vancouver. It might be out of province. It could be multi-unit. It could even be out of country. So in Vancouver, very, very expensive. We got a $2.6 million Vancouver house, makes about $5,500 in rent. If I was to put 20% down payment on this house, then I would need a $526,000 investment. The problem is with the interest rates. I put the interest rate at 4.25, amortized it at 30 years. You're going to have this massive, massive, massive negative cash flow, $6,000 per month. The cap rate is 1.79. So this is what I would say the average person can find on their own. They can just go out and they can look on the MLS and find this house. Is this a good investment? Well, it's not going to lose money when you sell it if you hold it long enough, but you're going to be in this negative cash on cash return. So I wouldn't say it's the best investment out there for all of that hassle. Absolutely not. This over here is something that we've done with clients. There were 3 of these units. We have 1 left. I cannot disclose the area, but I'm happy to have a conversation. So there were. This is basically a 3-plex. It generates $5,800 a month in rent. It's got a cap rate of 5%. And the internal rate of return, which is what we would compare it against other returns like the stock market, is about 14%. So it's obviously not in BC, and we're looking at a 20% down payment, but this cash flows. This cash flows right off the bat. We did a 4.3% interest rate, so we kind of used the same criteria. But what I want to kind of recommend over here is that if you're thinking about diversifying, you should be working with the right partnerships. And if you are an investor, 100% you should be looking outside of province as well, just because there are better deals out there, especially with multi-unit. Okay. So this property over here, there were 3 of them. There's 1 left. This over here is going to cash flow on day 1. So we get that positive cash return, and we have a double-digit return on our investment. So this is why the high net worth all invest in real estate, because of course they want the leverage. Okay, so what are the opportunities as we wrap up over here? Opportunities in 2025. I think buying power should be stronger, as Ryan has alluded to. So if you have cash and if you are able to make a purchase without a sale, especially, you should have some fantastic buying power. As Ryan also said, don't wait for buyer confidence to return, because then prices will go up and we get the craziness as well. On my side, if you're an investor, think about maybe something that Ryan is talking about on the smaller side. But if you're willing to think outside the box, out of province, multi-units out of province seem to be the ones that we're getting the best deals on. In terms of the stock market, Canadian private equity is whether you do it for the rates of return, whether you want to do it because you don't want to, the US currency is really, really bad, or you do it just for patriotism. We're recommending Canadian private equity. The TSX is going to be just like the S&P. It's going to be volatile like crazy. And then if you're somebody who wants to take advantage of a crash stock market, keep your eyes on a 20% drop from year to date. Just keep an eye on the news, and then 30%. Back the truck up. It's the best sale of probably since the 2008 crash. Okay, so to remind you, at Latitude West, we are a financial firm that not only participates and is licensed for insurance and investments, but we believe in the planning and the real estate as well, which is basically what that helps to differentiate us. We're always pro real estate. We're always pro real estate with our company. And that's essentially where the most stable and diverse returns, as well as the largest returns, have been for the majority of our clients. Okay, so in conclusion, don't try to time the markets. Don't panic sell. Devise a new strategy, because this is going to be an interesting year with an interesting ride. And as always, try to find some real estate opportunities. If you can't find this on your own, work with a team that's able to do this for you. Okay, so I want to keep this at 1 hour. Now would be a great time if any of our participants wants to throw something in the chat, a question for myself, for Dara, or for Ryan. So while our participants are thinking of a question, I have a couple of questions as well. And the first one is going to be for Dara. Dara, my question is variable or fixed? If I was getting a mortgage today, and whether it be renewing one or starting a fresh one, would you go variable or would you go fixed?
Great question, tough one. I think, as I mentioned, it's we don't have a strong thesis right now, and there's a lot of uncertainty. So I think you really got to do what's best for your risk tolerance. The spectrum is as follows. You've got variable is obviously the risky play. I wouldn't talk someone out of it. It might absolutely win in the end. It historically has. However, got to sleep at night. Got to be comfortable with that risk. The other end of the spectrum is like a 5-year fixed or longer. That equally comes with a bit of risk in a way, because if rates go down, it's going to hurt. But you look at it like buying insurance. You're going to set it, you're going to forget it. Your payments aren't going to change for that period. No matter what happens in the market, you turn it off and you don't think about it. And you have something that's comfortable for your budget. And then in between, you've got a 3-year fix, which is a bit of a nice middle ground where you define your payments for a shorter period of time, and you have the flexibility to pivot if they do keep going down, right? So that's the way I look at it: is where does someone fall on that spectrum?
Got it.
We have enough stress in our life. We have enough uncertainty with our investments and other variables. Where's the comfort level, and what's going to allow someone to sleep best at night? And that's how I would approach it. For those that can't decide, there's even some more sophisticated options. Not common, and not many banks offer it, but a few do, where you can actually split it. You can go half fixed, half variable. Enjoy some of the cuts if we get them, but feeling comfortable that you're not just going to get totally blown out of the water if they were to shoot back up. So that's the way I would approach it. I would talk to an advisor, help them and analyze your risk profile and make the decision based on that.
Yeah, and I think there's another question for Dara. It says, what strategy do you advise for renewal? Stay with the current bank or shop around? Like, I know for me, I am very, very loyal to my bank, except shopping around. I'm loyal to bank, but I'm also if the differential is pretty high, you want more money going onto the food and to your kids. So I know I personally would be shopping around, but I know, Dara, when you and I have worked with clients before, a lot of times you circle them back to their bank.
Yeah, you know what? I'm glad you asked that. That's a great question. That's my MO for that situation, because at the end of the day, Staying with the same bank is the path of least resistance. It's literally agree on a rate, sign a piece of paper, you're done. There's no requalification, right? Moving to another bank, I think it's worthwhile to shop for the record. But moving to another bank, people have to be aware that you do have to requalify. You have to update an application, have a credit check, provide income verification, all that stuff. So what I typically suggest to my clients in that situation, if they're happy with where they are, they don't want to make any changes, they just want to renew and get the best rate. I tell them, go back to your bank and get a quote for the term you want. Let's just say it's 3 years, for example. They go back and they get it and they come back to me and we compare it to the market. If it's good, I'm going to tell them that. Take it and run. If it's not good, but they still want to stay in, they don't want to jump through the hoops, I'll give them a quote of what my best is, just a simple quote by email to take to their bank, use it as leverage to see if that bank will match. If they match it, fantastic. They sign, they're done, everybody's happy. If they won't match it and we do the math and there is meaningful savings, then absolutely let's jump through the hoops. Christian, like you said, that's going to put more food on the table or maybe pay for a plane ticket or something. So yeah, let's jump through the hoops and move it.
Absolutely. And Adair, working with you, I've always said, well, Adair, you did all this work and you didn't get paid for any of it. And I think your idea has always been, you know what, I'll catch them the next time round. If the bank could do the best thing, but I want to be the first name when they decide to shop around again. And I think that's a great strategy.
Yeah,
Um,
thank you. I do believe we've built our business based on giving people advice on what's best for them. So we want, we typically get rewarded with that.
Absolutely. So I just want to be mindful of time, but really quickly over here, there's a question on for Ryan. It says, "Is it a good time to get into pre-sales?" Ryan, I'm not sure if this means pre-sales is in a brand new pre-sale or a pre-sale that someone is trying to sell. Why don't you tackle both of those questions?
Yeah, so the ones directly from the builder, I'm gonna say no, to be honest. Like there's definitely some deals, and a lot of the builders, developers product is not moving. But the problem is with those ones, a lot of the buyers probably paid less than you getting in now still, and they've had a lot of pretty aggressive promotions. So it's just difficult to time. Like another buyer might have paid a lot less than you in the same project. So I would look at the pre-sale options more at ones that are going to be closing pretty soon, and we can help with that. We're in some of those chats that we've helped other clients with. These are ones where someone has bought a couple of years ago and it's now coming up to close and they're at a loss. And in some of these cases, they just want to walk away with it and get some of their deposit back or break even. So I would say pre-sale ones that are about to close, I wouldn't deal directly with the builders at this point, to be honest. There's just too much uncertainty.
Yeah, okay, great. I'm going to field this last one myself, and then I think I'm going to cap it off. But we're still going to stay on. We're just going to end the recording just because I know there's a lot of other questions. But um, if there are people that would like to connect, this is our contact information. I have a newsletter as well if you'd like to keep up to date, which is free to join. Feel free to join. Scanning the QR code will get you in touch for a meeting if you want to talk further, or if you just want the newsletter, just put in the comments that you want the newsletter. If you want to reach out directly to myself, to Dara or Ryan, here is our email addresses. As we hit the last question, but like I said, we're going to field the rest of the questions. I'm just going to turn the recording off. One question is, given the uncertainty with the market and rates, is it right now too risky a time to borrow and invest, possibly using the Smith maneuver? There can't be any quick answer to that because every scenario is different. But what we do offer is, because we are Smith maneuver certified. A lot of people don't realize that they've been using the Smith maneuver correctly, which is why there's a certification. My recommendation to the person who said this is to connect with us, because I don't want to say, yes, it's a good time to do the Smith maneuver, or no, it's not, and then you run away. It really should be analyzed with your entire situation. Is it a good idea to do Smith maneuver in general? Yes. We wouldn't have gotten Smith maneuver certified if we didn't think it was. It's just a way to deduct your personal home interest to your taxes, because in Canada, you can't deduct your personal home interest. So more or less, the Smith maneuver is a way to do that. But the conditions in which that it's done is not as easy as you might think, and it definitely isn't for everyone. So I would say use a Smith Maneuver certified advisor if you were thinking of doing a Smith Maneuver. So here's our contact information. Me and the team, we're going to stay on the call right now, so please don't go anywhere. But we are going to end the recording. And for those of you who are listening to the re-recording, please feel free to reach out for a complimentary call. And thank you guys for even listening. And I know it's going to be a volatile year over here, so keep getting educated as well. So I'm just going to stop the recording. And I'm going to thank you guys for coming and joining.